So before we get started, check out the following links in the description box below as highlighted in the image shown. So you'll be able to get our past papers, our link to our official website, link to accreditations, our link to donation page, and contact details in the description. So once you'll be watching a certain video of any lesson or of any past paper, you'll be able to get all these links, and you can be able to get to download past papers, to reach to our official website. You'll be able to see links to our accreditations so that you can see which authorities have accredited us. You'll be able to reach to our donation page as well as our contact details.
Yes, so welcome class. We are going to look at the ATD Level 1 Introduction to Financial Accounting paper that was done in April 2024. So let's get going. Question 1. When a check is dishonored after being deposited into the bank, it should be credited to which account? Yeah. When a check is dishonored after being deposited into bank, it should be credited to. So what you need to do here is track the double entry concept, and the question is actually here: when a check is dishonored after being deposited into the bank account. So deposited into the bank account. The question is, how will you treat this when you deposit a check into the bank account? It's very simple. When you deposit the check into your bank account, you debit. That's an increase in asset. Money coming into your business through a check is an asset. Cash in bank is an asset. So what are you supposed to do? To debit. So when we deposit money into bank, we debit. It's a debit entry. We debit the bank account. Debit the bank account. Now, if the check is dishonored thereafter, then it simply means that we credit the bank account to show that this money that we had treated as incoming is no more, to reverse the transaction that we had entered. So when the check is deposited into the bank, we debit. If it is dishonored, simply means that that money is no more and we had already debited. What do? We credit that same bank account to reverse the entry that we had already made. So then back to the question. When a check is dishonored after being deposited into the bank, it should be credited to, the answer is the same bank account. When it was deposited, it was debited to the bank account. So when it is dishonored, we go to the same bank account and credit it to show that this transaction actually never happened. We are actually reversing the transaction. So it should be credited to the bank account. Now let's come back to the multiple choices. We have bank account, cash account, a drawers account, dishonored account. Bank account, correct. Cash account, no. It cannot be cash account because the bank was involved. Drawers account, no. These are nowhere close to the answer. So the correct answer is bank account. We credit the bank account because we had initially debited the bank account to show that money has come in. So that is the correct answer. A, bank account. Allow me to delete this. So then let's move to question 2. Move to question 2. Which accounting principle states that revenue should be recognized when it is earned and expenses should be recognized when they are incurred? Which accounting principle states that revenue should be recognized when it is earned and expenses should be recognized when they are incurred? This accounting principle is called accrual principle. It's called accrual principle, and it actually states that revenue should be recognized when it is earned and not when it is actually received. When it is earned and not when it is actually received. And expenses should be recognized when they are incurred and not necessarily when they are paid. When they are paid. So it is the time that you incur the expense that you need to recognize, and not when it is paid. You can pay the next year, but because you have incurred it this year, it should be recognized as an expense for this year, though payment possibly will be done next year. That is the accrual principle. So the correct answer is A. A, the accrual principle. B, not the correct one. C, not the correct one. D, not the correct one. Though it's very important that you also get to know this, because you never know what tomorrow holds. So the correct answer in our case is A, the accrual principle, and it says that revenue should be recognized when it is earned and not necessarily when received, and expenses should be recognized when they are incurred and not when they are paid. Let's move to question 3. Question 3, Webex Limited, a company dealing with sales of factory machines, sold factory machines and tools in the month of March 2024. The company incurred 50,000 as carriage outwards on the machines. Carriage expenses incurred should be debited to which account? Webex, a company dealing with sales of factory machines, sold factory machines and tools in the month of March 2024. The company incurred 50,000 as carriage outwards on the machine. Now, we need to know, what we need to note here is that we have something called carriage outwards. We have carriage outwards and carriage inwards, and carriage inwards. Now, carriage outwards is the cost that you incur trying to transport goods out of your premises. So, of course, goods, when they come out of your premises, they are going presumably to the customers or to your clients. So carriage outwards is associated with sales. You've sold the goods and you are now transporting these goods to the customers. In most cases, it comes as an after-sales service. You just transport the goods to the customers, maybe to improve on your relations with the customers or something like that, or it's part of the deal. So that cost that you are going to incur to transport the goods to the customers is what we refer to as carriage outwards. It's purely an expense. It's an expense. And what are we supposed to do to expenses? Expenses are debit entries. Expenses are debit entries. Then, before we come back to the answers to that question, let me just see. Carriage inwards, that is a cost that you incur when you are transporting goods into your organization. Carriage inwards to your organizations. So it's associated with purchases. You bought goods from the suppliers, so you are transporting them to your organization. We call them carriage inwards. The cost of transporting purchases to your organization. That is what we refer to as carriage inwards. It is also, we may not really say it's an expense, but we say it is a cost of sales. So it appears in the trading account when you are preparing the statement, the financial statement. It appears in the trading account because it is associated with the cost of sales. It is a cost that comes in with the purchases. So normally what we do, we take the purchases plus the carriage inwards. Okay, back to the question. Webex Limited, a company dealing with sales of factory machines, sold factory machines and tools in the month of March 2024. The company incurred 50,000 as carriage outwards on the machines. Carriage expenses incurred should be debited to, the answer is, because we are talking about carriage outwards, the answer is should be debited to the carriage outwards account. This is the correct answer. It cannot be the machinery account because machinery is an asset, and what we are talking about here is an expense. Expense should be debited to the respective expense account. And in this case, the respective expense account is carriage outwards account. It's an account that can stand on its own name, so we simply debit that account. Remember, we said that it's an expense and expenses are debit accounts. Purchases, no. Carriage outward is not related to purchases. Carriage outward is related to sales, not purchases. Purchases related to carriage inwards. So this one is definitely no. Trading account, no. It is carriage inwards that we've said is a cost of sales which will appear in the trading account. Nevertheless, if we were to record, if this was to be a carriage inward instead of carriage outward, we will still have opened a carriage inwards account and not the trading account. Trading account is a bigger account. So the correct answer is B, carriage inwards account. That is the correct answer for this question. Now, let's move to the next question. Move to the next question. What does the term debit generally refer to in accounting? What does the term debit generally refer to in accounting? Now, debit, we have the concept of double entry. We have the debit and we have the credit. Debit and credit. There's no clear definition of what debit really means and what credit really means, but we can define using what happens in these respective accounts. For example, we talk of an increase in asset. This is definitely a debit. Increase in expenses is definitely a debit. Then increase in liabilities is a credit entry. Increase in revenue is a credit entry. And do you have any other one? Let's see if we have any other entry here. And of course, we are talking about equity here. So equity could be part of liability, but let's just talk of increase in equity. This is capital. Capital, credit entries, revenues, credit entries, liabilities, credit entries, an increase. So the opposite is also true. We can bring all this. Decrease in all this will feature on this side, and decrease in this will feature on the credit side. So decrease in these three elements here that we have will feature on the debit side of the ledger, and decrease in these two, assets and expenses, will feature in the credit side of the ledger. And I hope that is clear. This is what happens when you talk about debit and credit entries. So what does the term debit generally refer to in accounting? Number one, an increase in asset or expenses. Increase in asset or expenses, you can see, so that one is correct. A decrease in asset or expense. Debit refer to a decrease? No, we said a decrease in asset or expense will appear on the credit side. So this is definitely wrong. An increase in liabilities or equity. An increase in liabilities or equity. An increase in liability or equity, you can see increase in liability or equity. This would be on the credit side. So definitely it's not a debit. So this one is wrong. These are a credit. This is also a credit. Then a decrease in liabilities or equity. A decrease in liability or equity. A decrease in liability or equity. Yes, a decrease in liability or equity would appear on the debit side. So this also qualifies to be a debit entry. So then, what is the question asking? What does the term debit generally refer to in accounting? An increase in asset or expense? True. A decrease in liabilities or equity? True also. And I think possibly this is where now this term comes in. What does the term debit generally refer to in accounting? Generally, what comes into any person's mind when we talk about debit is this: an increase in asset or expenses. Or if we talk about a decrease, this is also incomplete. We talk of a decrease in liabilities or equity, or even revenues. And revenue should also come in here. A decrease in liabilities, equity, or revenues. That should also come in as a debit. So we can simply say that this is incomplete, and also it when we talk about what comes into a person's mind generally when we talk about debit, again, this may not be the case. Immediately we talk about debit, what will come into a person's mind is assets, increase in liability, increase in expenses. When we talk about credit, what will come into a person's mind? First thing will be increase in liabilities, increase in equity, increase in revenues. So the answer that will be most appropriate for this question will be A. And I will go with A simply because of the way it has been framed. Because the question is generally, what does the term debit generally refer to in accounting? It is an increase in assets or expenses. So let's go with that. Allow me to delete this so that we can have a neat piece of work. So that is it. Now let's go to number 5. Number 5, what is the main purpose of international financial reporting standards? International financial reporting standards. I would like you to take note of this word international, underline it. International is global, and financial reporting standards generally to set standards for the global world so that we can all communicate the same language, uniformity, and basically it's to allow us have the same standards all over so that a person in Kenya can understand the books kept by a person in Finland. That is basically what IFRS is there to do. But let's see what the multiple choices present us with. So the main purpose, again, you may need to underline here the word main purpose. It means we could be having so many other purposes which are correct, but the main one, what is the main purpose of IFRS? Number 1, to create different accounting standards for different countries. Definitely this is not the case. I've even already talked about it, that uniformity. We want uniformity so that somebody in Kenya can understand the works of somebody in Nigeria. So to create different accounting standards, no. We are talking about creating the same accounting standards, similar accounting standards. Then to provide a single set of global accounting standards for listed companies. Yes, to provide a single set of global accounting standards for listed companies. This is very much correct and in order. I will go with it. To provide a single set of global accounting standards for listed companies. Possibly where I'll put questions is here. Listed companies. Why just listed companies? It should be more than listed companies. But otherwise, to provide a single set of global accounting standards, very much perfect. C, to help small businesses with their bookkeeping practices. Not really, because you're talking about ensuring that we have uniformity in the standards of application for the uniform interpretations. Now, these small businesses with their bookkeeping, yes, but not really. And that's why I started by underlining this, the main purpose. To regulate financial markets international, no. IFRS work is not to regulate financial market. This is something totally different. To regulating financial markets in Kenya, this is the work of CMA, Capital Markets Authority. It's not even anywhere closer to what IFRS does. It's not the work of IFRS to regulate financial markets. So I will go with this one, to provide a single set of global accounting standards for listed companies. But this listed company, not we should not constrain ourselves to listed companies. We're talking about both, generally all businesses, not just listed companies. But of course, it's listed companies that will want interpretations, in most of the cases beyond the borders. Thank you. So the correct answer is B. According to the multiple choices that we have, the correct answer to this question would be B. So having said that, let me just allow me to clean this. Allow me to clean this so that you can have a clean piece of work. And I've said that the correct answer to this question is B. So there we go. Now, question number 6. What does the term accounting period refer to in the context of a business? What does the term accounting period refer to in the context of a business? Accounting period. Accounting period is the period within which you are, preparing the books of accounts. And the period can differ. It can be 1 year, it can be 6 months, it can be, depends with what the management wants or what the purpose of the books that you are generating. So let's go back to the question and see what it has for us. What does the term accounting period refer to in the context of a business? The specific calendar year the business operates in. The specific calendar year the business operates in. This could be correct, but it has some weaknesses. It is correct, but it has some weaknesses. The specific calendar year the business operates in. We can prepare books for the previous accounting period. It is very much allowed. It's okay to prepare books for the previous accounting period. Now, what this Roman A is saying is that the item A is saying is that the specific calendar year the business operates in. Not really. So I will not go with this. The specific calendar year, not really. The business operates in. It could be the previous year. Accounting period could be for the previous year, could be even for the 2 previous, Then B, any chosen period of time used to measure the financial performance of the business. This would be the most appropriate answer for that, I guess. Let's continue with the others. The period between the founding of the business and its closure, not really. The business could have been found in 1897 and possibly it's not even contemplating closure. So this is definitely wrong. And you cannot call the whole of that period accounting period. No. The tax year as defined by the government. The government is also not, the government's tax year is defined by you. Because you can have your tax year running from July to June, or from January to December. Not really. And remember, when we keep the books, we don't just keep for the government. We also keep the books for our own consumption. And again, the accounting period is not necessarily a year. It could even be 6 months, 9 months for the purpose of distribution of dividends. So this is also not necessarily correct. So the correct answer, going by what we have been presented with in this question, would be B. Any chosen period of time used to measure the financial performance of the business. Question 7. Which of the following is not a source document used to record revenue transaction? Which of the following is not a source document? What this means is that all of them are source documents, but which one is not a source document used to record revenue transaction? I think what we need to underline here is revenue transactions. So invoice. Which of the following is not a source document used to record revenue transaction? An invoice. Invoice is used to show the customer, is a document that is used to show the customer how much is supposed to pay you. I mean, I've supplied you with the goods, so how much are you supposed to pay me? The invoice will show the amount of money that the customer is supposed to show you. Is it associated with the revenues? Yes, because whatever you present to the customer is what he will pay you. Receipt, that is after the customer has paid you, you are going to issue him with the receipt. So of course it's a source document that is associated with revenue transaction. Purchase order. Purchase order? No. Purchase order and revenue? No. Purchase order, it's you who is buying from the suppliers. Now when you are buying from the suppliers, does it become a revenue to you? No. Becomes a cost to you. So purchase order is associated with the costs, not revenues. Checks, yes, Checks is associated with the revenue because after issuing an invoice, the client will give you a check and then you will issue a receipt. And actually that's the you can see you issue the invoice to the client receives the invoice and does a check to pay you, and once you are paid, you issue a receipt. So all these are transactions that are associated with revenues, except purchase order, which simply is a document that is sent by you to the supplier, asking him to supply you a certain set of goods. No, and of course that one is associated with the purchases, and purchases are a cost to the business. It's not a revenue. So the correct answer here will definitely be C. The correct answer will definitely be C. C, which is a purchase order. Okay. So this is the correct answer, C. So then let's look at question 8. What is the difference between a sales journal and a sales return journal? Difference between sales journal and sales return journal. These are two books that are very much source documents that are so very much related. Sales journal is used to record the sales. Sales return journal used to record the sales that have been returned into the business. Have been returned into the business. So what is the difference between a sales journal and a sales returns journal? I think the difference is very clear. This one, sales journal, used to record the sales done by the business on credit, and then this one, sales that have been returned into the business. You've sold to the client and the client has returned them back into the business. So let's look at what question 8a. The sales journal records all credit sales, while the sales return journals records all cash sales. This one up to here would be correct, while the sales return journal records all cash sales. This is wrong. Sales returns journal doesn't record cash sales. Sales returns journal records sales that have been returned into the business. So that A is definitely wrong. The sales journal records all sales of goods or services. This is correct. While the sales returns journal records returns of goods previously sold. This is also correct. The sales journal records all sales of goods or services. It could be on credit or cash. While the sales returns journal records returns of goods previously sold. That is also correct. You've sold the goods and they have been returned. Then number C, the sales journal is used by manufacturers while the sales return journal is used by retailers. Definitely wrong. Definitely wrong. Definitely wrong. You can't define using the users. It is the functions that the two books perform. There's no difference. They are all the same type of journal. No, they are different. So what is the correct answer? The correct answer simply remains B. B becomes our correct answer. That B remains our correct answer. What is the purpose of using a petty cash book? Petty cash book is used to record all minor expenditures, all frequent minor expenditures. Frequent minor expenditures. So let's look at what the question is all about. What is the purpose of using a petty cash book? To record all cash transactions of the business regardless of amount? No. We've said minor. Letter B. To track small, frequently occurring cash payments for minor expenses. This is definitely correct. I will go with this one anytime. Let's see if we have any other. To reconcile the bank statement with the cash account in the... No. The petty cash book doesn't reconcile the bank statement with cash account. No. A bank reconciliation does reconcile does the reconciliation, but a petty cash book, no. It just deals with the frequent minor recording of the frequent minor expenditures in an organization. Then D, to store cash securely and limit access to authorized personnel. No, this is not the work of a petty cash book. It's just a record. It's not, it doesn't store petty cash securely. So the answer is B. B anytime. B will be the answer to that particular question. Thank you. Now let's meet in the next question. So that starts from number 10 to 17. Let's meet in the next question. Thank you.
So if you like this video, you can always enroll with us. You'll be able to access more of these revision sessions, and also you'll be able to find well done lectures or pre-recorded videos for all the KASNEB courses as well as CHRP. And in case of anything, you can always reach us out. We have our contact details on the screen. Feel free to call, feel free to WhatsApp anytime. So thank you, and let's meet in our next session.